Sunday night, nobody is pricing AIG's assets. They're pricing whether it can make morning. In this business, tomorrow is a funding product. They called it an insurance company. That label doesn't survive a deadline. AIG wasn't collapsing from claims. It was collapsing from collateral. For years, it sold protection on mortgage-linked debt through credit default swaps. It looked clean, fees in, risk out, until housing rolled over and the market stopped treating those promises as distant. The damage wasn't the mark, it was the trigger. AIG's contracts were wired to its credit rating. A downgrade didn't just insult the firm, it converted confidence into cash requirements. Counterparties demanded collateral, then demanded more, then demanded it faster. AIG could argue solvency, it couldn't post time. Asset sales were too slow, borrowing was too expensive, and every hour made the next call larger. Because weakness tightened the terms that created the weakness. A buyer doesn't buy that. A buyer inherits it. The clock comes with the company. So the Federal Reserve arrived with something colder than rescue: structure, an emergency facility, and control priced in equity, about 79.9%. Not because the government wanted an insurer, because AIG wasn't one company. It was a guarantee sitting inside everyone else's balance sheet, because the system needed a counterparty that couldn't miss a collateral call at dawn. The irreversible moment wasn't the loss on paper. It was the downgrade that turned promises into immediate cash. In modern finance, control doesn't belong to whoever owns the assets. It belongs to whoever can meet collateral today. And when collateral becomes the currency, the state becomes the only lender left.